So our key picks in the best ideas section that Tom talked about just before are TPG and NextDC, sort of hedging our bets a little bit there. One's a value stock, one's a momentum stock. I guess on the telco sector in general, you asked me to talk just a little bit about what's happening in the sector and why things could change. It's been terrible for the last few years, without a doubt. Been through the ringer. The big three have basically raced each other to the bottom on pricing to get no change in market share. So the million-dollar question there is, do we return to more rational pricing? And if that does happen, then you'll see everything start to go up, the whole sector. We've got that telco shopper you may have seen. We've been tracking mobile prices and NBN prices for a number of years now. There's been a few little signs of improvement, but nothing dramatic yet to guess really move the dial there. But at least it's not going down at a crazy rate, which it was for a while there. So I guess if you put that aside, other reasons to think that prices should go up. Number one, that NBN rollout is done. Believe it or not, they've basically built the NBN now. Number two, TPG, Vodafone have merged, so more rational competition. Number three, 5G has been launched, as you'd all be aware, so that's differentiating networks. And probably the more significant one recently, fourth and final point, the CEO of Optus has changed. So the guy that used to run Optus, Alan Liu, basically initiated a pricing war with Telstra. Telstra followed Optus down in order to keep customers. It didn't work, clearly. All the returns got smashed. And basically what you've seen now is there's a new lady called Kelly Bayer who is running Optus. She's a former CBA investment banker, and she's basically said, we're not getting a decent return on capital, which is, I think, sort of signalling they're going to look to change prices to try and get a better return. So clearly, if that happens, prices go up and everyone wins. That said, we're hedging our bets. We're sticking with TPG because we think it ticks a lot of boxes and it's got upside potential without a price change. Just as a reminder, they've got a lot of unused spectrum because TPG, the pre-merged entity, bought a ton of spectrum that they couldn't use. Now that they've put the two businesses, Vodafone and TPG, together, you've got a lot of spectrum, which obviously they will use to add more customers in a fixed cost business. That will jam more revenue and more earnings through the business. It is trading on about a 6% free cash flow yield. And I know everyone's been banging on about founder-led businesses. This is one of the original and strongest founder-led businesses on the market. So that's TPG. Do you want me to talk NextDC, the second one? Yep. It's come off a little bit. Obviously, there's been a bit of rotation from growth stocks into cyclical recovery stocks. There's no doubt in my mind that earnings for NextDC will not go backwards. This is a business that did 100 mil of EBITDA last year. Based on what's already signed and business as usual, it will make $200 million of EBITDA in the next 3 or 4 years. And then on top of that, there are options that could see that go to $300 million in the next 3 or 4 years. Clearly, there's been a bit of movement and excitement and disappointment about all the tech sort of stuff, but it's pretty obvious we're not going to unlearn Zoom or stop working remotely, and all of that stuff, or a large chunk of it, is actually hosted with NextDC. So I think it's got some really strong tailwinds behind it in terms of massive structural growth. And the company also recently completed its debt refinancing, which gives them nearly $2 billion of funding, which is clearly cheap funding and will help drive earnings. So I think that's a great story to be chipping away at now.